All right. Hi there. This is Christian Dye and from Latitude West Financial, and I am giving the new challenges for both dental and medical graduates for 2021. My guest is Lynn Chammy. Pronouncing it correctly, Lynn?
Absolutely.
And she is a lawyer that is also going to be from Corp Med Legal, who will also be talking to us a little bit about mistakes to avoid, looking at incorporation. So let's get right into it over here. So we're going to talk about first year mistakes to avoid if you are either entering into a residency or entering into a first year of practice. We're going to talk about what to do with your loans versus investments and how to prioritize it. And then we're going to talk about real estate, whether you should buy or whether you should rent in the area that you are first going to practice in. So some new challenges for today. A question over here, 20 years ago, what was the average student loan for either a medical or a dental student in 2001? And the answer was somewhere between 25 and 50,000. That was the student loan average. Today, that number is between 150 and 300,000, depending on the program that you're in. So, what was the average Canadian income to housing ratio 30 years ago compared to today? So, the income to housing ratio is how much household income do you have versus how much house did you buy? So it was about a 3-to-1 ratio. So what that means is if your household made $50,000 per year, then you bought about a $150,000 home. Now, in Canada, it is closer to 6-to-1. And in places like Vancouver, it's about 9.8-to-1 today. So if somebody in Vancouver household makes about $100,000 of income, household income, they're buying about a $1 million property. It goes to show you what some of these new challenges are and what we can do about it. So for those of you who are graduating this year, what should your greatest financial priority after graduation be? And the quick answer is it depends. Everyone's scenario is different. And it's so incredibly important to do a good financial analysis because you can't just go off of what, your family members or what your classmates are doing as their financial plan. Some of them might be saying pay down your loans as fast as possible. Some of them might be saying get in the stock market as fast as possible. Everyone is going to be different because everyone's scenario is different. So that's why the answer is it depends. Okay, couple quick little housekeeping issues over here. If you've got a question, by all means, we'll save it to the end. We'll leave some time for questions at the end. Also, all of our contact information will also be given at the end. For those of you who are dentists graduating, if you're already my client, you're probably on my Instagram at Latitude West Financial. Just a reminder, I give a $50 Visa gift card weekly draw every single week just by answering my financial question, which is usually a pretty easy question. However, if you are in medical residency or a medical student, we use a different one at Christian Dye Latitude West. And for those in medicine, we ask that you join this one. The reason why we keep two separate ones is because we sometimes have separate workshops geared towards different faculties. And sometimes it's easier that way. So if you are in dentistry, at Latitude West Financial, and if you are in medicine, at Christian Latitude West for the $50 Visa gift draw. So let's get into some of these mistakes. So I've broken it down to some common mistakes that I've seen before. And mistake number one is budget planning. And the quick mistake is that you don't do any budget planning. And the reason why you have to do some form of budget planning is because you are now drawing an income, which also means you are also paying taxes, which also means that you have probably living expenses such as rent or mortgage. And if you are starting a full practice, perhaps you're a dentist, then you'll be making a full income. If you are in residency, a medical or a dental residency, you're kind of making a partial income. Either way, you should have some form of a budget plan. So what I do with my clients is I organize them by figuring out how much money is coming in and what are the expenses coming out. The key things that I'm looking for whenever I do this with my clients is what percentages are going towards housing, what percentages are going towards food, transportation, debts, and how much cash flow is there per month. Now, the reason why you want to do this type of planning is because, for example, let's say that you're about to take on a mortgage or take on, some rent. What you want to do is you want to make sure that you could actually afford it based off everything else that you're doing. So, what I want us to do over here is to make sure that you guys are get correct budget planning whenever you are starting off practice. If you need sort of a budget planning sheet or you need some assistance, I'll give you my email at the end, and I'd be happy to share some of my resources with you if you don't already have your own. Okay. The other big one I like about budget planning is to figure out what your income ratio is. So here, my budget sheet calculates my income ratio. Now, an income ratio is when you take your income and you take your expenses and divide it by your income. The lower the ratio, the better, because the expenses are made up of things like taxes, rent, mortgage, restaurants, gas. But what's not included in the expenses are things like loan payback or investments. So that's why we want the number to be as low as possible. We take the expenses and divide it by the income. I could tell a lot from clients by knowing what their income ratio is. And, a great income ratio might be 70% or 60%. Some people have income ratios of 99%. And I could tell right away their loans are never going to get paid off. They're never going to have enough to invest off of. So if you're first starting out, let's try to figure out what your income ratio and your cash flow is. So you'll have two types of deductions: fixed deductions off of your expenses and variable deductions. So I want you to think about this. If you're entering into residency, they're going to take about 36% of your income off right away. You need to forecast for that because they're actually going to take off your income taxes. They're going to take off different types of expenses. So any type of a unionized type of employee usually has this amount. Now it varies from province to province over here, but if you are, self-employed, maybe you're starting your medical or dental practice over here. One of the things to realize is you now have to put these fixed deductions in yourself. You have to start doing budget planning yourself. And the one that I highlight the most is probably taxes. If you're starting and you're self-employed, you now have to forecast how much your tax bill is going to be and start a system to start taking it off. Because of course you're going to be paid in gross, but now you have to figure out your own net. So variable deductions is the next one. These are the ones that you have control over. So you're going to have some options over here. You're going to say, well, how much should I start planning for paying down my loans? That's up to you. How much should I start planning for a down payment on a home? How much should I start planning for, TFSAs or RRSPs or, something else that you might want to take as a variable deduction? That's why if you don't do any form of planning, essentially you're going to end up having an income on a monthly basis that you just end up spending. With the correct amount of planning, you can sort of start to map things out. And most times you need some help with this because you're not sure which one to prioritize over here. Okay. So how much should I budget for each over here? Depends, of course. Depends on the scenario that you're in. Depends on the rent, down payment. Depends if you're married or if you're soon to be married. Depends on the location of where you're living. So what I do with my clients is I do a cost benefit analysis and we figure out how much should go to each of these buckets over here. Sometimes paying down loans makes the most sense. Sometimes getting a down payment on your first home makes the most sense. Okay. So, I'll give you guys a couple of different case studies throughout to help us to understand some of the options over here. So I want you to imagine you're a couple newly married during your medical residency over here. Now you're starting your medical residency, you want to start a family, and you're thinking of buying a home. Now you got $50,000 in student loans, and you also have no money saved up for a down payment. You have an available $250,000 line of credit that's available to you. So what you have over here is you have these different options. So if you find yourself in this case scenario, you'll probably know what the options are. Number one is you can say, I'm going to prioritize paying down my loans, and I'm just going to keep renting during my residency. I'm going to wait until after residency in order to do any buying of a home. So there's one option. Option number two is you're going to use your line of credit to potentially put as a down payment on a home. So you're going to basically buy right away. So that means the student loans are going to be the second priority, or you might deal with the student loans after your residency. Option number three is you might say, I'm just not going to do anything. I'm not going to pay down my loans, and I'm also not going to buy a place. I'm just going to continue to the rent. So this over here are the types of things that I see with people who are entering into residency. And what is it to do? What is the right answer? And the quick answer is, of course, it depends. It would depend on how expensive is the real estate of where you're about to live. How long are you going to live there? Do you have an exit strategy for when you do leave? Is it going to be easy to sell the place, or can I now hold it as a rental property? So, a good cost benefit analysis could help us to answer this case study. And that's exactly what I would do with my existing clients over here. For some of you, you might be able to do this analysis on your own. But if you're not able to do this analysis, this is some of the recommendations of why I would say to get some help over here. So here, if in this type of analysis, this is what should be done. You should be comparing the cost to buy a home versus the cost to rent during your residency. Some places have very, very high rents, and some places have very inexpensive real estate. You would then take the difference, and that would be the opportunity cost. You would then compare the opportunity cost investment, such as in the stock market, against the future equity value inside the home. And you would compare to see which of these two is greater. So so you would assess if cash flow can sustain the new mortgage as well. You don't want to be too tight, and you also want to see if you even qualify. Now, the piece of value that a good financial advisor brings is if you don't qualify, they could give some ideas and show you different ways in order to qualify, ways that you probably didn't even know was available to you. That's what a good financial advisor should do if you have real estate as one of your priorities. So a sensitivity analysis is another thing I would recommend, and a stress test on the 5-year renewal. So a sensitivity analysis is to try to understand, how sensitive is your budget if the rates start to move on you, for example. How sensitive is your budget if suddenly you decided to have a family during your residency? Can you still afford the home? So this is the different types of forecasts that a good financial plan should be able to take care of. So whenever I do a financial plan, I always help clients to understand it graphically, to try to understand if we were to, keep renting and maybe take any extra money, pay down loans, where would you be in 10 years from now? If we were to buy earlier, and then where would we be 10 years from now? To help them to realize, is it worth the extra, the expense? Is it worth the extra cost in order to buy versus rent? So like I said, a lot of people need help with this type of cost benefit analysis. But if you are able to do it on your own, this would be my recommendation. Okay. So speaking of which, we're at Latitude West Financial are giving complimentary financial and tax planning for those in their residency. So, for my existing clients, we always do a graduation financial plan. And for those of my clients who are listening now, if you haven't booked an appointment, please do soon. But for the new clients that I'm talking to out there, if you need some good financial planning because you're not sure whether to buy or rent, and you're not sure how to structure your taxes, by all means, give us an email, and we'd be happy to set up an appointment. So now we are also partnered up with an accounting firm, which is giving complimentary tax returns during your medical or dental residency. And so if you're somebody who feels that you need to, you want to, you have to file your taxes every single year, but you want to use our complimentary service, give us a call and we'll set up a time and go through it. Now, unfortunately, this is a limited quantity for residents, but we give these every single year. We have a limited amount, so it is a little bit on a first come, first serve. And we also want to talk to you to make sure that there's a right fit as well. And we are national, so we can do out of province. So right now, across Canada, give us an email and we'll talk you through it. So mistake number 2, loans versus investments. Okay, so here's our case study. We've got somebody with $150,000 of debt They want to know how long it will take to pay off their loans based off of, and I'm using a 2.75% loan rate per year. Now, the reason why I don't use the current loan rate, which is closer to 2.2, is because the variable rate does change over time. So what I want to do is I want to make sure that I'm using a rate that is sort of used as an average. So I've got my calculator over here on the side, my TVM calculator. So let's say, for example, you contribute the minimum. The minimum is going to be around $300-400 per month. So if you said, I'm going to contribute $4,800 per year towards my loans on a 2.75%, $150,000 debt, how long will it take me in order to pay off these loans? So here is the math behind it. We're going to calculate how many periods, which is, of course, how many years it will take. And the answer is 72 years. That's how long it will take if you just paid the minimum of 150,000 at 400. So now I'm going to save people an enormous amount of money. So here's how I'm going to save you some money. What if I convince you to just increase it by $200? That's it. So instead of paying the minimum of $400 per month, instead we're going to pay $600 per month. How dramatic of a sensitivity analysis does that make on the loans? And here is the answer: 31 years. So now I'm down to 31 years, which is a lot more accessible. I think 72 years is a little bit excessive. Now, what if we get a little bit more aggressive and we go all the way to 2000? So right now, this is sort of that person who is now making full dental or full medical income, and now they're aggressively paying down their loans on the 2000 per month. So 24,000 per year, how long will it take? 7 years to pay off our loans. So now we're down to 7. So here, what if we go very, very aggressive, 4,000 per month, so 48,000 per year, we'd be done the loans in 3.3. So right away you're thinking, I got to accelerate and pay down the loans. I got to accelerate. So the quick answer is maybe. Remember, it depends. It depends. So here, there's 3 different loan payback strategies I'm going to give to all the people listening. So all physicians and dentists going into residency or going into a practice can do a pre-plan as a loan payback strategy. So here is option number 1, consistent increase. Let's say you're about to enter into a medical or dental residency, and let's say it's going to last for 4 years. Now, money's already going to be tight because you're entering into this residency. So what you might want to do is take about 5 to 10% of your income to slowly start paying down your loans, okay? If you're a medical resident, maybe you're making $50,000 per year, 5 to 10%, that's somewhere in the neighborhood of 2,500 to 5,000 per year that you're just paying this off. But then you start your first year of practice. And for the dentists, some of the dentists out there, they're already going to be starting their first year of practice. You start doing the 10 to 20% first year of practice. So you slowly keep increasing it. And then you get a little bit more aggressive with the 30 to 40% until it's fully paid off. So that's the consistent increase method. The next one is called the aggressive payback method. Now, aggressive payback is all through my residency, I'm just going to min fund my loans. Whatever the bare minimum is, I'm just going to min fund it. But as soon as I start practice, I'm going to aggressively pay it off. And the way I'm going to aggressively pay it off is I'm still going to keep my expenses similar to when I was in residency. So even though I'm making, $70,000 as a, R4, and then all of a sudden you jump to making $300,000, you still live off of under $100,000 per year. You're going to have so much extra cash flow to put towards that loan payback. And then we have option 3, delayed payback. So option 3, delayed payback, is saying I'm going to prioritize other financial priorities before I actually do the pay back my loans. So my other financial priorities are going to be down payment on a home, or my other financial priorities are going to be, investing in the stock market. So should I be doing option number 3? You need a good cost benefit analysis to see if this one works over here. So case study. Let's take this case. We've got somebody who's got a recent grad with about $193,000 in student loans. Now they just finished their residency, or they're a first year dentist. now earning 250,000. They want to buy a home, but they also want to pay down their loans. They want to plan for retirement, but they're also unsure whether or not to incorporate. So what are their options over here? Well, option one, just pay down the loans as fast as possible. And I will admit that from a lot of the clients that I come across, a lot of them do option one. They said, I'm just going to pay down my loans as fast as I possibly can. I'm not going to invest in the stock market. I'm not going to buy a home. Wait till all the loans are paid down. So that's option one. Option two, I want to invest in the market. I've got friends who are making a lot of good money in the stock market, and I think I want to get involved really, really quickly. Option three, I want to buy a home. I want the down payment on a home as fast as I possibly can. So this over here is a perfect example of somebody who's not sure what to do, and they will need some good financial planning. They should not ask their friends what to do. The problem is that's like asking medical advice from your friends, and your friends aren't doctors. That's like asking mechanical advice from people who know nothing about cars. The good thing to do over here is you want to do an analysis. And if you can't do it on your own, you need help. You need a good financial plan. So this is the type of planning that me and my team would do. We would create a loan payback strategy, and we would give options. So here's option one. Let's say your loan rate is at 3%. And let's say you're trying to pay back 193,000 of loans, and let's say you could afford $1,000 per month in those loans. Well, what you're going to end up happening over here is we're going to do an analysis on you, and we're going to realize that it's going to take you 22 years to pay back the loans at that rate. Now, of course, if you could add more, we could always add more. Now, option two is, well, what if we looked at paying down a portion of the loans and a portion that goes into the stock market? What we would find over here in that same 22-year time frame, you would still have some loans, but your investments will have overtaken the loans. So you'd actually have 101,000 as a future value of net equity. And this is if the market was receiving 6%. Now, let's say you said option number three. What if I purchased a property instead and put the extra cash that I made back into the loans? Where would I be 22 years from now? Well, again, you'd have you'd still have loans at the end of the 22 years, but you'd also have a real estate property, and I used one growing at a 4.5% cap rate, and you would have even significantly more. Now, this all depends on many different factors, such as the real estate, such as the market returns. But what this is analysis in order for us to determine what is your best option. So again, good financial planning is what I would recommend. Take advantage of our grad financial plan if you have no one else giving you a hand with this. So I want to shift gears over here about incorporating. Some people listening right now are newly graduated dentists. Some people listening right now are newly graduated physicians, full practicing. And if that's the case, that question is going to come up, when should I incorporate and what are the times when I should incorporate? So I'm going to shift it over to Lynn, and she's going to get us started and answer our question. Go ahead, Lynn.
Well, great. Thank you so much, Christian, for the introduction and also for hosting this webinar. I'm really pleased to present the incorporation topic today for everyone listening. And it's such an important topic and a very common tax deferral strategy that many medical students, residents, and dental grads hear a lot about as they're about to graduate, and they all know that eventually they're going to have to do it. It's just a question of when, like you said, when is the right time to do it. So today we're going to go through the basics of incorporation. I'm going to show you the ideal corporate structure. I have actually two ideal corporate structures that I'd like to present to you, and then we'll move on to the 6 benefits of incorporation. So this brings me to my general message about incorporation, which is it's really an important milestone in your tax planning. So it's important that it be done properly and with somebody that truly knows how it functions because your corporation, and as we're going to see in the next slides, is a professional corporation. It's not a regular business corporation. So make sure that you're dealing with somebody that specializes with healthcare professionals as you're creating your corporation, because you have to get authorization from the order. So we'll talk about the basics of incorporation at first. So essentially, what is incorporation? Incorporation is the legal process that is used to form a corporate entity. So essentially, what happens when you incorporate a business or a medical practice is that you create a legal separation between the owner, so the physician, the dentist, and the corporation's income, assets, and liabilities. Now, I want to really put a point on the fact that when you create that legal separation between the owner and the corporation's income, assets, and liabilities, that means that the owner, the physician or the dentist, has its own tax rate. They pay their taxes on the personal side, and the corporation has also its own tax rates. So on the personal side, the rates will vary between 44 to 53% in terms of marginal rates. And in terms of the corporate rate, it's usually between 11 to 20%, depending on which province you're in. So if we apply that principle of legal separation, that separate income, that separate those separate assets and liabilities to a professional incorporation, this means that you have your doctor or your dentist that are running their practice through what is not a regular business corporation, but a professional corporation, like I was saying. And in order for you to exercise your practice within your corporation and to bill through the corporation, you have to be allowed by your professional order to do so. So you have to, your lawyer will incorporate you, and then you'll have to get an authorization from the professional order, and which is why it's important to do this with somebody that really truly specializes with healthcare professionals. And here at CorpMed, we specialize with healthcare professionals across the country. So whether you're in BC, Manitoba, Ontario, Quebec, we take care of incorporating in really across the country, and we take care of obtaining the permits and the authorization from professional orders across the country. So rules may vary between the orders and provinces. Make sure it's just done properly because it's a different corporation. So this brings me to my next point, which is the ideal corporate structure. So we have two different corporate structures that, in my opinion, are ideal depending on what your plan from a short to long term looks like in terms of investments. So the first structure, type A, we have Dr. X, which he owns controlling shares in MD Inc., which is a medicine professional corporation. You have the professional revenue that's coming in. So when they see patients in clinic, they bill directly through the medical corporation. And then you have the option as you bill and as you earn some income in your corporation to either take out a salary or take out a dividend out of your corporation. Now, as we saw earlier, in terms of the legal separation, Dr. X and MD Inc. have two separate income statements. They have different bank accounts, they file their taxes differently. So essentially, in the MD Inc., you're getting taxed at corporate rate. In Quebec and in Ontario, it's about 17.5%. Out in BC, it's a little bit less, about 11%. But essentially, all of that excess professional income will be taxed at a corporate rate rather than your marginal rate. Like I said, that varies between 44 to 53%. So essentially, Dr. X, as they are incorporating, they'll be able to really bill through the corporation and get the maximum tax deferral that they're able to do, and we'll see that a little bit more in the benefits of incorporation. But essentially, this is really the most basic structure that you have for an incorporated professional. They just make the revenue within the corporation. They could do a little bit of investments, but usually I don't advise to do your investments directly within your medical corporation for two reasons. The first one being that your order, depending on the province, again, will usually not allow, and it's a gray zone, for you to have real estate investments within that medical corporation. So if you're thinking of doing any real estate investments, you can't do them within the corporation. You have to have a separate corporation. Which brings me to my next corporate structure, type B, which shows two different corporations, the same initial structure where you have Dr. X owning 100% of the shares in MD Inc., another medical professional corporation. And then on top of it, you have the holding corporation in which you'll be able to do your investments, your real estate investments, or any kinds of investments that you'd like to do within that holding corporation. And what's great with this type of structure is that with all of the excess professional income in the medicine professional corporation, again, that I remind you is taxed at corporate rate, you can issue what we call an intercorporate dividend that is tax free from the medical corporation onto the holdings Inc. So you can fund your investments through dividends that are tax free. Instead of taking it out on your personal side, paying your taxes, again, between 44 to 53%, and just essentially shipping the money from your medical corporation onto your holding company in order to fund your investments. So this is really, in my opinion, the ideal structure for most physicians and for most dentists. What's great also about this structure is that if, for example, you have a clinic and you own the real estate, a great way to set this up is to have the real estate directly within the holding. So you'll be able to charge rent between the corporations, and also you'll be able to pay off your mortgage probably that you have on that building without having to take out the money personally and then getting taxed on that and then paying off your mortgage. It's directly from the medical corporation onto the holding company based on a tax-free intercorporate dividend. So that's really a great way to invest, to start your clinic. In my opinion, this is really the best corporate structure for professionals that eventually will invest. So this brings us to the next slide, which is the 6 main benefits of incorporation. So quickly, I'm just going to go over, I've summarized essentially these benefits of incorporation, and there are others. There are other benefits to incorporating, but these are the main 6 ones that we have. The first one being asset protection. So asset protection is essentially the main non-tax reason for somebody to incorporate, because as we saw earlier, it really creates a legal separation between your personal assets and your corporation's assets. So essentially, if there were to be a lawsuit or something that's not necessarily covered by insurance, or somebody gets injured, you would not be personally held liable for the debts and obligations of the corporation. So this essentially really limits your exposure as an owner and as a shareholder of the corporation, because creditors cannot access your home, your personal finances, your inheritances, and also your other investments if they're in a separate company, like we saw in type B corporate structure, if they're in a separate company, because as we know, they are 2 separate entities as well. The other benefit, apart from asset protection, that is really probably the most important one, is tax deferral. So as we said, on the personal side, you're probably going to be taxed on the highest marginal rate when you take out money out of the corporation. Like we said, it varies between 44 to 53% across the country. So any surplus income that is retained inside the corporation is going to be taxed at a much lower rate, at the corporate rate. And like we said, it can even be invested. So by incorporating, what happens is that the professional that would be otherwise taxed at the highest marginal rate will have approximately twice the funds available for investments. So by incorporating, really, you are benefiting from tremendous tax deferral. And at the end of your career, if you want to use, for example, that medical corporation or that holding company as really just your retirement fund to fund your retirement, it's a great way of doing it. You can recycle your medical corporation so that you're able to invest directly within that corporation as well. So tax deferral for as long as you're practicing and even after retirement. Then another benefit of incorporation is certainly in terms of insurance benefits, and I'm sure that Christian will be able to help you out with all of this, putting them all in place. And the easiest way to explain the insurance benefits is really through an example. So essentially, imagine that you have a doctor that practices in Ontario. Personal marginal rate is 53%, and there's a permanent life insurance, and the premiums are $2,500 per year. If you are not incorporated, that doctor is not incorporated, having a marginal rate of 53%, they need to earn about $5,320 a year to fund that policy premium on the personal side. If, on the other side, that same doctor is incorporated and they're funding that same $2,500 premium for the insurance policy that they have, they, as opposed to $5,000, $5,000 a year to fund that same premium policy, they only need to do about $3,000 because of the corporate tax rate that is much lower on the corporate side, rather than having to pay for the premiums directly and personally at marginal rate. So it's almost a $2,000 difference over 20 years. If your insurance policy is over 20 years, that's about $40,000 to $45,000, depending on how expensive the premium is. So having your insurance directly within the corporation and funding it through the corp is really a good strategy and a great benefit, in my opinion, of incorporation. Now, another terrific benefit of incorporation would be the lifetime capital gains exemption. And this is in the case of clinic sales. So this is going to be very pertinent for the dental students and grads, and also a few of the doctors, the physicians. So essentially, for many healthcare professionals that are also clinic owners, you could truly greatly benefit from this exemption upon the sale of the shares of your practice. And I'm putting the emphasis on the sale of the shares of your practice, because if it's an asset sale, if you're selling equipment and just assets bit by bit, you won't be able to benefit from this exemption. It's really upon the sale of the shares of a practice. This is why incorporation really is linked to the lifetime capital gains exemption and is listed as a benefit of the incorporation, because it's upon the sale of the shares. Now, I'm not going to get into the details of the criteria in order to qualify for the lifetime capital gains exemption, because it's very complex. But just to give you an idea of how much the lifetime capital gains exemption is at right now, in 2021, the exemption is around $900,000, and it's indexed every year. And it can even be multiplied if you're set up properly with a family trust, and if your order allows you to have a family trust. Essentially, that approximate $900,000 exemption can even be multiplied with family members that are part of that trust. But really a great benefit for clinic owners upon the sale of the shares of that clinic. Then we move on to another great benefit of incorporation, which is income splitting. So essentially, income splitting consists whenever you have a high rate taxpayer, such as a healthcare professional, that transfers part of his or her income to a family member that is taxed at a lower tax bracket. Now, this obviously has to be done reasonably, in the sense that you can't possibly think that the CRA is not going to raise its eyebrows when they look at the salary that you pay your 19-year-old daughter, I don't know, $100,000 to be a secretary at your clinic. It just doesn't really make sense. So it has to be done reasonably. And it's only useful, obviously, if the family member with whom you're income splitting is taxed at a lower tax bracket. Now, be careful to avoid the income tax attribution rules by consulting with an accountant and with a lawyer to really guide you through the income splitting, as it is a bit of a sensitive topic. And like I said, has to be done very reasonably in order for you to be able to benefit from it. So this brings me to the last benefit of incorporation, which is having the flexibility to choose between a salary and a dividend. These strategies really will open up some great doors for you, and sitting with your financial planner and your accountant, you'll really be able to see and evaluate, depending on your income, depending on your plans, short term, long term, what is the best way to take money out of the corporation? Is it a salary, a dividend, a mix of both? So essentially, just to give you a quick 911 crash course between the difference between a salary and a dividend, is that essentially a salary becomes an expense to your corporation. You'll be able to also put into everything that I call social benefits, like your EI, your retirement plan, things like that, as opposed to the dividend, which is essentially just taking money, excess cash out of the corporation. The tax between a salary and a dividend is a little bit different, but depending on the amount that you're taking is going to really vary, and you should take a look with your accountant and your financial planner to find that sweet spot between the salary and the dividend, or the mix of both. I went through all of my information pretty quickly, and usually my presentation is a little bit longer. And if you would like a little bit more information, I can send you really the PowerPoint on everything from the benefits of incorporation, the corporate structures. If you'd like to have more information, simply send me an email, and I'd be happy to send it that way. If you also have any questions about incorporating, you're thinking about incorporating soon, you're thinking of joining a practice, which will be our next topic for the next presentation. And if you have questions just about corporate structure, or if you should incorporate, if the timing is right for you, I'm more than happy to answer all of your questions. The consultations for graduating students and physicians and dentists are free at CorpMed Legal, so feel free to reach out if you have any questions.
Oh, that's great. And I think I want to highlight over there that what we're trying to do is we're trying to get people who are graduating either in medical or from dental school, to get them as much good advice and basically complimentary advice. We're going to show you our value right away, and then you can choose whether to work with us in a long-term relationship. So by all means, take a picture of the email and the phone number over here. Just remember that Lynn is basically nationwide. She can help people regardless of which province they are here in Canada. The other thing that I just wanted to quickly add before I move on is one of the reasons why I wanted to pair up with Lynn is because her fees are actually significantly lower across the board, across the provinces. And I think a lot of people do need holding companies and operating companies. And she's able to set those up because really at the beginning, there's not much going into them. So really you should be paying such high prices in order to set them up we've seen some very, very large fees, and being able to have a trusted resource who specializes with physicians and dentists to make sure that it's set up correctly, but also to make sure that the fees are very, very reasonable for what we're putting inside of it, which is little to nothing at the very, very beginning. So I will, put it out there to, by all means, reach out and to start and to take that complimentary conversation if you are a dentist who might be incorporating soon or buying a practice, or if you're a physician who's now just graduated from residency and also incorporating soon. So what I want to do is I want to transition a little bit, keep mindful of time. So the last topic over here is on real estate. Should I buy or should I rent? So this applies to people not only who are in residency, who are not sure they're committing to 2 or 3 years, but also people who are finished residency or people who are starting a dental practice and they're not sure whether to buy or rent, or to prioritize loans. So I'm going to try to give you guys some clarity through case study over here. Okay. So let's imagine over here that you are recently graduated, either a dentist or a physician, you're moving to an area and you know you're going to be there for about 5 years. Now, the real estate out there is actually fairly inexpensive. Let's say it's outside of Vancouver, outside of Toronto area, and a condo you can still get for 250,000. Now you've got $50,000 available, either from cash or from a line of credit. And you're trying to debate, should I, put this money, get to work in the stock market, or should I get this money moving in the real estate market? So your options are, I could rent and invest in the stock market. There's option one. I could buy a place for 5 years, and then I could sell it when I move back home or move to another area. Or I could buy a place for 5 years, but then keep it even if I did move back home and keep it as an investment for retirement. So what do? It depends. We need to, of course, do a cost benefit analysis. So I'm going to show you the type of cost benefit analysis that I would do with my clients over here, okay? So here, let's pretend the rent in that area was $1,200 per month, okay? What are the possible future values of the real estate? And it depends on the growth of the real estate in the area. So that's the first thing I personally would analyze, okay? So if you're going to put $1,200 a month for the next 5 years over here, you're paying about $72,000. So that money is lost, But here, let's say that we have this $250,000 condo, and let's say we qualify to buy this based off of our income. Well, what is the future value? Well, the quick question is, what is the growth rate in the area? So I'm going to do a sensitivity analysis on you. Let's say that there's a range. It's either going to grow on the low side, let's say 2%, on the high side, let's say 8. So let's say 2, 4, 6, 8, depending on the area over here. For 5 years, what is the value? At 2%, that 250,000 5 years later is only worth 276. At 4, it's 304. At 6, it's 334. And at 8%, it's 367. So you notice over here that you're somewhere between 276,000 and 367,000 in value. But now, let's say that we use the 335. So let's say it grows at 6% over here. So at 335,000, 5 years later, after paying out closing costs, I do decide to sell it. When I sell it, I also have a remaining mortgage of about I also pay out the remaining mortgage. So let's say I gross around 113,000. So I've already done the math for you over here. Now you're thinking, was I better off putting this in the stock market? So now you got to think, what's a decent stock market return over 5 years? And your range should probably be somewhere between 4 and 8%. So what is the return on my $50,000? So I put in 50,000 and I received 113,000 of equity. So what is the rate that I got over that 5 years? 17.7%. Now, one of the things I also want to point out about that 17.7 is if you lived in it in Canada, that is a capital gains tax free. Now, if you were to invest your 50,000 in another vehicle, it literally would have had to been in a TFSA because that's the only other vehicle that is capital gains tax free. But if you did it in a non-registered, of course, there'd be a taxation on it, okay? So here, well, what if you picked option 3? What if I said, hey, what are my long-term values over here, Christian? What if I decided to not sell it after 5 years? I move back home, but as I decide to keep this as an investment property. Now, what are the future values? Well, let's take a look 25 years later. Again, I'm going to go 2, 4, 6, 8, but this time I'm going to use 25 years. I'm now looking at 410. 666, 1.1 million, and 1.7 million. Somewhere in that range will be the value of that condo. Okay. So here, what's the ROI after 25 years? So again, let's pretend that I got 6% annual, and 6% is actually the Canadian average of real estate, by the way. So 25 years later, after fulfilling owning with no mortgage, you now sell for $1 million. And we're, of course, having some assumptions over here. One assumption is that the rent that you rent it out for is enough to cover the mortgage, the strata, and all of the other fees. So it doesn't cost you any money. And I could do the math if it did cost you money. And I could also do the math if you were to cash flow, because that math is a lot trickier. So here, after paying everything out, let's say you gross about $1 million, about 72,000 is going to be the closing fees. What's your ROI as a percentage of capital? Now, remember, you only put $50,000 in it initially, but 25 years later, you end up getting $1 million. What is the annual rate of return on this? And the answer is about 12.7. Still fantastic investment over here. Now, if this guy, we start to get in the weeds a little bit, if we talk about taxation, because it's no longer principal resident and things of that sort. But that's what a good financial advisor is able to do. They're able to calculate if it makes sense to do this type of investment as opposed to the stock market or as opposed to something else. Now, the reason why my practice is unique is because I can add another third asset class over there, and that's your own practice. What's the ROI of reinvesting in your own dental practice or medical practice or joining a dental or medical practice? I could compare that to the stock market as well as to the real estate market. So I thought I'd show this one over here, and this is Vancouver 2021. And some people said, well, where do you get some of these numbers from? Now, whenever I do an analysis, let's take a look. The Lower Mainland itself had a 10-year average change of 95.3. I reversed that into an annual rate of return. That's about 6.9. So for the last 10 years, the Lower Mainland of Vancouver has appreciated by about 7%. I could also dissect different areas in order to show you what their historical rate has been. And if you were to move to, let's say, Manitoba, or you move to Alberta, I'm able to do the same type of analysis. So, what if you said, Christian, your $250,000 example, I'm moving into a very expensive area. So, a starter 2-bedroom condo in the area I'm going to is about 550,000. Let's say it's Toronto or it's in Vancouver. Well, what are those future values? Well, again, I wouldn't use a number probably as low as 2%. I'd probably go 4, 6, or 8. And I'd say, does the math still make sense if you're going into a fairly expensive area? So here are the numbers. On a 4%, 1.4 million, that $550,000 home that you're buying would go at 1.4 million. At 6%, it would be 2.4 million. And at 8%, it would be 3.7 million. And the other thing is there's so many other strategies with real estate that you could have in order to leverage, in order to buy more real estate, or to use the equity to buy your own personal home if you don't want to use it just for investment. And so right now we should be thinking, oh, maybe that's why I should set up my holding company, because one day I might be transferring the asset that I had in residency into my holding company when I incorporate. Okay. So why do I like to use real estate as an investment whenever I talk with clients over here? The tax advantages, the cash flows, the sheltered capital gains, the leverage that you're allowed to do from banks, which you cannot do with stocks. What are some of the downsides? It's not all pretty. Well, of course, there's vacancy rate. There's capital expenditures like having to replace the roof. You might have to deal with bad renters. And it's also more time consuming than traditional stocks. But what I like to do in my practice is I like to sort of see where's the client at, what are they thinking? And I'd like to go where they are in order to help them to create a financial plan. And then, of course, I like to use the analysis to show, does this make sense? Does it make sense to buy 2 properties, one during residency, keep that one, then go buy your own home? And I would show them whether mathematically it makes sense or not. And I'd also show them what does it look like if they were to get 3 properties and hold them in the holding company. So at Latitude West over here, when we do a financial plan with clients, we start with a discovery meeting. The discovery meeting discovers what is your goals? What is it that you're trying to accomplish over here? Because everyone is different. We would then navigate in our next meeting to figure out what are the options that I have in order to implement them. And then we go on to the implementation. The implementation is, now what do I need to put in place? Do I need to pre-approve? Do I need to start a TFSA? Or do I need to aggressively pay back my loans? And then, of course, we stay with our clients. So, that's our process here at Latitude West. And our company is also national. We are licensed in the other provinces as well. So if you're not in BC, but you're out east or in another province, by all means, we still can service you. So a lot of times our clients start on the insurance side and get put in some basic insurance, and then we start talking about investments and advising. But we do help with the financial and the corporate planning. We do also have partnerships with our tax team over here, and we continue to teach through workshops and webinars. So once again, as I slowly wrap up over here, we have complementary financial and tax planning through Latitude West. So if you're graduating and you said, I need a good graduation financial plan, I'm not sure whether I should pay down loans, or I'm not sure whether I should buy a home, or I'm not sure whether I should invest, then you need some good planning. And we do a complimentary but a limited quantity for people who are entering into residency. If you're an existing client of ours in dentistry or in medicine, we do this as a complimentary service for our existing clients. So make sure you book that meeting. But if you're not a client and you said, I want to get a complimentary financial plan, connect with us, and then we'll tell you what the next steps are. And if you're also somebody entering into a medical or dental residency, and you said, I need help with the tax planning because I got to file my taxes every single year, then again, we also offer complimentary tax returns partnered through our company if you are in your residency. But there's a limited quantity for people who are in residency, so we ask that you contact us in order to take advantage of it at assistant@latitude-west.ca. If you've got any questions right now, would be a good time to enter them into the chat. What I want to do is I wanted to invite people to ask questions for Lynn or myself into the chat, and we'll be happy to field them for you. So is there any questions that anyone would like to ask us? Okay, what I'm going to do is I'm going to ask Lynn a question to get us started over here. So Lynn, my question to you is approximately what would you say is the income amount where people should seriously start to consider about incorporating?
That's a very good question. So I get asked this question so many times, and the answer is there is no amount that you should make in order for you to think about incorporation. It's not about how much you make, it's essentially about how much you're able to save, how much retained earnings you should have in your corporation. Usually, I would say between 40 to $50,000 of retained earnings is when it starts to make sense for a physician or a dentist or any healthcare professional to incorporate. So whether you're making $250,000 and you're spending all of your income, or you're only making $120,000, as long as you're able to save between $40 to $50,000 in the corporation, this should be really your cue for incorporation, not necessarily how much you make.
Got it. And then one other question over here is if you were to incorporate
Mhm.
and you didn't, and you had a piece of real estate that was on the outside because you
Yep.
bought it personally, uh, is it difficult to start to now put it on the inside of the holding company? Is there a taxable disposition there?
That's a very good question also. So there you could do what we call a Section 85 rollover. So essentially, you would take the property, the asset, even a piece of land if you have, and you would roll it over. And essentially, a rollover is a tax-free transfer that is done between an individual and a corporation, or a corporation to another corporation. But there essentially is no tax consequences. You're deferring the tax consequences, the capital gain that you would have normally triggered from a transfer or a sale of that building or that land that you have when you transfer it from you personally to your corporation, because essentially it would be deemed technically as a sale, but through the rollover, it is not deemed as a sale. There essentially is no capital gains that is triggered. Now we have to be careful also with transfer fees and mutations and taxes like that, depending on in which province you are. So obviously consult with a lawyer on that part. But in terms of triggering capital gains, we could do a Section 85 rollover, and there would be no tax consequences on that end.
Perfect. So what I want to do is be mindful of time, but I do want to invite everyone to our next webinar on June 16th called Starting or Joining a Practice. This could be a medical or a dental practice, and the do's and don'ts if you are joining a medical or dental practice over here or starting one up yourself. The other one is some tax planning for the first year of practice and incorporating some top mistakes to avoid. So Lynn and I will be hosting this on June the 16th. If you'd like to sign up, you can do it through the Latitude West Workshops website, latitude-west.ca workshops. Just go to the June calendar and click on the 16th in order to register. So one last time, there is Lynn's information if you'd like to connect with her. Like she said, the advice that she gives off of a first phone call is all complimentary. So you might as well try to figure it out, especially if you're thinking about incorporating. And if you wanted to take advantage of, if you're already an existing client and you said, I want to do some planning before I graduate over here, then by all means, go through an assistant at latitude-west.ca in order to book a time. And if you're a brand new person to Latitude West and you're thinking of taking advantage of our complimentary tax planning or our complimentary grad planning, then by all means, connect with us and we'd be happy to help. So Lynn, I think we're going to end it off there. I think we're 1 hour on the dot. I will see you next time. And thank you everyone for attending. If you're listening to the recorded link and you found some value and some good ideas over here, or you want to share this with one of your colleagues, by all means, forward the link and invite them to have a listen. So I hope you guys have enjoyed these graduation mistakes to avoid, and I hope you join us with the next one. All right, talk to you guys soon.
Thank you.